If you're asking me, Kevin, when should I sell my gold and silver, I'm going to say something that might irritate you a little. You might be asking the wrong question. Not a slightly wrong question. The wrong question entirely. Because asking when to sell assumes something very dangerous. It assumes the system you're selling into is stable, trustworthy, and worth running back to with your pockets full of paper. Let me put it to you this way. Imagine you're standing on the deck of a massive ship. The lights are still on. The band is still playing. People are laughing, drinking, placing bets at the casino like nothing could possibly go wrong. But you can feel it. A vibration under your feet. A subtle tilt. Water where water absolutely should not be. And while that ship is taking on water, you're standing there asking, "So? What's the best price I can get for this lifeboat?" That's what the question sounds like to me. Look, I understand the instinct. I've been in markets my entire life. When something goes up, every neuron in your brain screams, "Take the profit, don't be the idiot who round trips it." That instinct has been trained into you for decades. Charts, cycles, buy, low sell, high repeat. It works beautifully in a world where the measuring stick doesn't melt in your hand. But what if the problem isn't the asset you're holding? What if the problem is the thing you're measuring it against? Because here's the uncomfortable truth. The system can be cracking, and most people will still act like it's business as usual. They'll debate timing. They'll argue over price targets. They'll wait for permission from headlines and talking heads who are still pretending the hull is intact. And here's where it gets awkward. If the thing you're thinking about selling is the very thing that doesn't rely on trust promises or someone else's balance sheet, maybe you should pause. Just pause. Because if gold and silver are lifeboats, the worst possible moment to negotiate their value is while the ship is still listing. So the real question isn't when do I sell? The real question is this. If the asset you're holding is designed to help you survive a system failure, what exactly are you planning to trade it for? And more importantly, when would that trade actually make sense? Now, let's talk about that feeling. You know the one. Gold spikes, silver jumps. You open your screen, your heart rate ticks up just a little, and suddenly a very familiar voice shows up in your head. This is it. This is the top. Don't be greedy. Take the win, and listen, that voice isn't stupid. It's not reckless. It's trained. Very well trained. We've all been raised in the same financial classroom. Price goes up, you sell into strength. Price goes down, you panic regret or swear you'll do better next time. We've watched charts our entire lives. Green candles feel like applause. Red candles feel like punishment. So when gold or silver makes a strong move, the reflex kicks in automatically. I don't want to round trip this. I don't want to look foolish. I don't want to give it back. That reaction feels rational. It feels responsible. And in a normal system, it usually is. But here's the part most people never stop to question. That reflex was built inside a world where the measuring stick was stable, where the currency itself wasn't quietly shrinking while you were staring at the price chart like it was the truth. We've been conditioned to think in fiat terms, dollar terms, pound terms, euro terms. We're told that's reality. Everything else is noise. So when someone says sell the rip, what they're really saying is run back into the thing you've been trained to trust. The charts reinforce it. The commentators reinforce it. The entire ecosystem reinforces it. Short-term thinking, quick wins, timing the perfect exit, as if the system itself will be there waiting for you, arms open, unchanged. But let me ask you something, and I'm not asking it to be dramatic. I'm asking it because it matters. What happens if the unit you're measuring everything against is the thing quietly losing integrity? What if the price going up isn't the asset getting expensive, but the currency getting weaker? because those two things look identical on a screen, but they mean very different things in real life. This is where we stop judging ourselves and start getting honest. We're not wrong for feeling that urge to sell. We're human. We're responding exactly the way we were programmed to respond. The danger isn't the instinct. The danger is never questioning whether the game we were trained for is still the game being played. Here's the pivot, and this is where a lot of people get uncomfortable. The issue is not when to sell. That's the distraction. The real issue is what you're selling into. Because the moment you say, "I'm selling my gold" or "I'm selling my silver," the sentence isn't finished yet. You're not selling into thin air. You're selling into something else. And that something matters more than the timing ever will. I'm not interested in selling gold or silver just to end up holding more paper promises. I've spent my entire career evaluating promises. I know how they're made, how they're marketed, and how easily they're broken when the math stops working. Fiat currency is a promise. It's a very polite promise, printed nicely, backed by serious-looking institutions, but still a promise. It exists because someone somewhere owes something. There's always an IOU hiding in the background. Gold doesn't have that. Silver doesn't have that. There's no counterparty risk, no balance sheet you have to trust, no central committee you have to believe will behave perfectly forever. That's not ideology. That's just structure. One is a claim, the other simply exists. So when people ask me, "Kevin, what's your price target?" I almost laugh. Not because it's a stupid question, but because it's incomplete. A price target only makes sense if the destination is sound. If the destination is questionable, then hitting the target just means you arrived safely at the wrong place. This is where the idea of a bridge comes in. Gold and silver are not the final destination. They're not trophies. They're not collectibles you admire forever in a safe. They are bridge assets. They're what you carry across a period of uncertainty so that when the next chapter opens, you're not starting from zero or begging for permission. And here's the important part. You don't cross a bridge by staring at the water below and arguing about the exact midpoint. You cross it when it leads somewhere solid, somewhere real. Productive assets, control, stability. Things that don't evaporate because a policy meeting went badly. That's why this isn't about vibes or gut feelings or hoping you nailed the top. This is about structure, framework, rules you can actually use when emotions are loud and headlines are screaming. And that's exactly where we're going next, because once you understand what you're holding and why the decision-making becomes a lot calmer and a lot smarter, let me make something very clear before anyone accuses me of being dramatic. This isn't about my feelings. This isn't about fear. This is about signals. Cold, unemotional signals coming from the parts of the system that usually whisper, not scream. And lately, they've been screaming. Every once in a while, someone on the inside slips and says the quiet part out loud. Not a blogger, not a YouTuber, someone who actually sits at the grown-ups table. And when you hear phrases like "the monetary order is breaking," coming from people who benefited the most from that order, you don't roll your eyes. You lean forward. Because that's not marketing, that's a confession. Now look at the bond market. This is supposed to be the most boring corner of finance. Bonds are where excitement goes to die, or at least that's how it used to work. But when long-term government bonds start swinging around like meme stocks, something is very wrong. That's not normal volatility. That's stress. That's the market quietly asking a very rude question: are these promises still worth what we thought they were? Here's the math problem nobody wants to solve on camera. When debt piles up and interest rates rise, the cost of servicing that debt explodes. Governments don't get to magically opt out of arithmetic. So eventually the choice is narrow. You either cut spending, which voters love about as much as root canals, you raise taxes, which creates its own kind of revolt, or you print. Or, if you want to be creative, you change the rules and call it stability. Every one of those paths has consequences. None of them are neutral, and most of them are quietly hostile to savers. That's where inflation enters the room, not as a monster, but as a polite thief. It doesn't kick the door down. It doesn't announce itself. It just takes a little purchasing power every month and hopes you're too distracted to notice. That's why I call it the quiet tax. Nobody votes for it, but everyone pays it. And here's the part people miss. When policymakers are boxed in, they don't choose what's best in the long term. They choose what hurts the least right now. That usually means protecting the system and letting the currency absorb the damage. From the outside, everything still looks orderly. From the inside, the incentives are shifting fast. So, no, this isn't panic. This is pattern recognition. When the safest assets stop behaving safely, when debt math stops making sense, and when inflation quietly erodes trust, the system is telling you something. It's not yelling yet, but it's clearing its throat, and ignoring that has never been a winning strategy. Let me paint this picture clearly, because this is the part people remember long after the charts are forgotten. Imagine we're on a massive ship, elegant, expensive, chandeliers still glowing. There's a ballroom where people are dancing like nothing has changed. There's a casino where someone is convinced the next hand will fix everything. Drinks are flowing, screens are flashing green. On the surface, it all looks fine. But below deck, something else is happening. You can't see it from the dance floor, but you can feel it. The ship is listing. The floor isn't level anymore. The crew isn't making eye contact. And water has an annoying habit of showing up where it absolutely does not belong. Now, in that moment, there are two very different kinds of lifeboats. Gold is the big one. It's compact. It carries a lot of value in a very small space. Not everyone can afford a seat, but if you're on it, you're dry, you're stable, and you're not begging anyone for permission. It's efficient, it's boring, and it works. Silver is the other lifeboat. It's heavier. It takes up more room. It's crowded, but it's accessible. A lot more people can climb aboard. And historically, when things get strange, silver has a habit of showing up where everyday transactions still need to happen. It's louder, it splashes more, and yes, it can be uncomfortable, but it still floats. Here's the key point, and this is where people get tripped up. These lifeboats have different roles, but they're on the same side. One is not a replacement for the other. They're tools designed for different needs, different scales, different realities. Thinking you have to choose between them misses the entire point. And here's the part that makes me smile every time because it's so human. Nobody, and I mean nobody, standing on a tilting deck with water creeping in says, "You know what? I'll trade this lifeboat for a handful of casino chips." The chips are up today. That conversation doesn't happen, because when reality sets in, paper games lose their charm very quickly. Gold and silver aren't about winning. They're about not losing when losing becomes fashionable. They're about stepping out of the ballroom before the music stops. And once you see them that way, you stop arguing about which one is better. You start asking a much smarter question. How do I use each one properly before everyone else realizes the ship isn't unsinkable after all? Now let's turn this from philosophy into something you can actually use, because ideas are cheap and panic is expensive. What keeps people stuck isn't lack of information, it's lack of a process. When emotions spike and headlines start shouting, "You need a filter," actually you need 3 of them. This is how I think about it, and this is how I stay calm when everyone else is refreshing their screens like it's a slot machine. The first filter is the system signal. Before I even think about selling anything real, I ask myself, A very simple question: is the system healthier or more fragile than it was before? I look at bonds, not because they're exciting, but because they're honest. Bonds don't lie for long. When government debt starts behaving like a teenager on energy drinks, that's not a good sign. I look at currencies, not their slogans, but their purchasing power. And I pay close attention to what central banks do, not what they say. When the people who print money are quietly hoarding assets that can't be printed, that tells you something. When those signals are flashing red, reducing your insurance because the price went up is like canceling your fire policy because your house didn't burn down this year. That's not bravery. That's poor risk management. The second filter is where most people finally have their light bulb moment. I don't ask if gold is expensive. I don't ask if silver is overbought. Those are lazy questions. I ask what they buy. How much gold does it take to buy a house where you live? How much silver buys a reliable vehicle, a piece of equipment, a business that actually produces cash? History is full of moments where those ratios go completely insane. Real assets get absurdly cheap in terms of hard money, but most people miss it because the dollar price feels normal. They rush in when houses are affordable in currency terms and panic when they're actually cheap in gold terms. That's how you end up working harder for less and calling it progress. When those ratios stretch to extremes, that's when exchange makes sense. Not selling out of fear, not selling because a chart looks scary, exchanging because the math is screaming that real stuff is on sale for real money. And here's the part that messes with people's heads. When that moment comes, it will feel uncomfortable. It will not feel obvious. If it feels obvious, you're probably late. The third filter is the most ignored and the most important. The personal signal. This isn't a spreadsheet. This is your life, your family, your health, your opportunities. If you need liquidity for an emergency, that matters. If a real opportunity appears that improves your control over your time or your income, that matters. The goal is not to die holding perfect coins and a very tidy spreadsheet. The goal is to live better. That's why I never think in all or nothing terms. I don't blow out positions. I exchange in portions. I keep optionality. I stay flexible. This is also where ego gets people hurt. There's no trophy for holding the longest or timing it perfectly. Markets don't hand out medals. If exchanging a portion of your holdings materially improves your real life, that's not failure, that's the point. What you never do is confuse patience with paralysis or conviction with stubbornness. When you put these three filters together, something interesting happens. Decisions slow down. Panic disappears. You stop reacting to every headline and start responding to conditions. You stop asking strangers on the internet what to do and start trusting a framework that actually respects reality. That's the difference between speculation and strategy. And once you experience that calm, you'll never want to go back to guessing again. Let me calm this down for a moment because panic is expensive and patience is free. In my own mind, I separate everything into two buckets, and this has saved me more times than I can count. One bucket is core. That's the stuff I don't touch unless something truly meaningful is happening in my life. Not a headline, not a bad week on a chart. Something real. The other bucket is tactical. That's where I allow myself to adjust, rebalance, maybe take advantage of volatility if the math makes sense. Here's the trick. I don't measure this in dollars. I measure it in ounces. Ounces don't scream at you. Prices do. Silver especially will try to mess with your head. It's volatile by nature. That doesn't mean it's broken. It means it's doing what silver has always done. Paper markets shake people out. Physical reality rewards patience. Volatility isn't the enemy. It's the filter that removes the impatient, and trust me, I've learned that lesson the expensive way. Let me leave you with this, because this is where most people still get it wrong. Monetary systems don't collapse in one clean moment. They erode in phases. Quietly at first, then awkwardly, then all at once everyone pretends they saw it coming. Confidence fades, markets behave strangely, rules get adjusted, and suddenly what used to be normal feels unreliable. That's how these things actually happen. Not with sirens, but with confusion. That's why there is no perfect selling price. Anyone promising you a magic number is selling comfort, not truth. The real opportunities don't arrive as fireworks. They arrive in waves. Ratios stretch. Assets quietly go on sale in terms that most people aren't watching. And by the time it feels obvious, the best part is usually gone. Gold and silver were never meant to be the finish line. They're tools. They're what you carry so that when the world offers you something real productive and lasting, you can say yes without begging a bank or trusting a promise that's already fraying. So, no, I'm not selling into paper just because the number looks big. I'm waiting. I'm watching, and when the exchange makes my life more stable, more controlled, and more resilient, that's when action makes sense. Next time we'll get very specific. Ratios, real examples, real decisions. Because that's where theory turns into advantage.